You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Comperl. Countries around the world are looking at central bank digital currencies, or CBDCs, to modernize payment systems and increase accessibility to the banking system. Different from cryptocurrencies and not exactly like the dollar in your online bank account, a CBDC in the US would be backed by the Federal Reserve and move seamlessly between different user accounts. On today's episode, we talk with Jim Cunha, former executive vice president at the Federal Reserve Bank of Boston, about the mechanics behind central bank digital currencies, the potential advantages of creating a CBDC, and the risks it may pose to banking sector stability. Stay tuned. Coming up soon, our interview with Jim Cunha, but first, a quick market update. Today's jobs report showed payrolls grew a meager 22,000 in August, and the unemployment rate rose from 4.2% to 4.3%. Payrolls were revised lower for the previous 2 months as well, pushing the June estimate to negative 13,000. The 3-month average for payrolls growth now stands at 29,000. The July PCE deflator rose 0.2% headline and 0.3% core, pushing the year-on-year rate of core inflation to 2.9%, the fourth consecutive increase. The gradual acceleration is adding to the concerns of policy hawks within the FOMC, but is most likely not enough to stop the Fed from cutting later this month. The July JOLTS report released this week showed some hints of future labor market deterioration if the trends were to continue in the coming months. The job openings rate fell and the layoffs rate increased, suggesting firms are starting to lay off workers at a faster pace without reabsorbing those who are out of work. More labor market slack could lead to a negative feedback loop of lower consumer spending and falling labor demand, which starts the process of a wider economic downturn. The Treasury curve bull steepened in the 2 weeks leading up to Friday's jobs report. Yields at the long end of the curve stayed range-bound, while policy-sensitive intermediate yields drifted lower as investors became more confident in a September rate cut. After the jobs report, yields fell further on rising expectations for additional rate cuts after September and slower future economic growth. 10-year yields fell as low as 4.09% at the time of our recording. President Trump said he was moving to fire Lisa Cook from the Fed's Board of Governors based on allegations of mortgage fraud, a move Cook quickly sued to stop. The courts have started to consider whether she can stay in her position while the case is being litigated. Also this week, CEA Chair Stephen Miran appeared in front of the Senate Banking Committee to fill the seat vacated by Adriana Kugler, who is expected to be confirmed and serve until the term ends in January. That's all for the market update this time. Now our interview with Jim Cunha. Our guest today is Jim Cunha, former executive vice president at the Federal Reserve Bank of Boston. Jim, thanks for coming on the podcast.
Glad to be here, Will.
Our topic today is central bank digital currencies, CBDCs. And Jim, as the leader of the Project Hamilton team at the Boston Fed that explored the possibility of a central bank digital currency, is in a perfect position to tell us all about them. So to start out, what is a central bank digital currency exactly? Breaking it down into its parts, it sounds like it's no different than the dollar in my online checking account.
In some ways, there are similarities, but if you look at central bank digital currency, for one thing, it's backed by the full strength of the government, just like a paper dollar bill is. It's a liability of the Federal Reserve. It also has certain statuses because of its legal tender status. Its value does not fluctuate. Now, what's different about that versus the money in your bank account, for instance, is that's the liability of the bank. It's actually an obligation that the bank has to give you your money when you ask for it. For the digital currency, is also the value is based on the trust in the government. In the case of a bank, it's based on the trust that the bank will give you your money, but also because of insurance, FDIC insurance, your value of your digital currency in the bank account is pretty much solid as well. But it's an obligation of that bank to give you the money. And also it comes with certain fees at times, either for moving the money or for storing it if you don't have a particular balance. Whereas a dollar is free to use. They act alike, but there's subtle differences as to what backs them and then how they move.
There are a few things there that I want to follow up on, but just to be clear before we move on, sometimes I think that term digital currency makes people think that it's something like a cryptocurrency. This is totally different from a cryptocurrency, correct?
True. When I describe these things, I'm being general about them because there are different types of cryptocurrencies, but generally a cryptocurrency is not backed by anything. There's no central authority, there is no company that backs it. It's really a currency that is basically managed by a consortium of developers and in some case miners. And also in cryptocurrency, the prices, as you've seen if you follow Bitcoin or the others, the price fluctuates dramatically because there's a fixed amount of them, and with supply and demand, the value can go up if there's more demand for it. It's definitely different than a cryptocurrency, and because there's a central authority that backs it and controls it.
I think that difference in the abstract that you described, how, in my online checking account, that's the liability of a commercial bank. In a central bank digital currency, it's the liability of the Fed. I understand that, but I think exploring details around a possible CBDC would help illustrate exactly what would happen. So, how would households and businesses functionally use one of these? If I go into a restaurant or I want to pay my phone bill, how would using my central bank digital currency account be any different than handing over my credit card that's attached to my commercial bank?
In a number of ways. It may feel the same. You go get a meal, you pay, you leave, and you think your obligation is done. But if you look at that business then has to collect on the credit card that you use, or just say you wrote a check. They don't have money. They have your promise to pay, and then they have to collect from the credit card companies or the issuing bank of that check. So from a merchant's perspective, those other ways of paying, it's not the end of the game. And they have to pay fees on top of credit cards and sometimes for processing those checks. If you gave them a digital dollar, a US dollar, they then have a dollar in their pockets. So it's similar to you giving them paper money. From the perspective of the merchant, it's dramatically different because of the cost of it and the immediacy of them actually having the funds. It could be just as easy to use, like you have an app on your phone, say Apple Pay, and you want to use a credit card, you've got other apps. You would have an app on your phone that would keep track of your digital money, and you would have an interface with that merchant. You would authorize them receiving the digital dollars. So it feels the same, but it acts very different under the covers.
I know in the last few election cycles, I think Bernie Sanders and maybe a few other people have proposed the creation of what's called the postal banking system. And my understanding of it is that the government would set up no-frills checking accounts for people who may be underbanked or unbanked. As you said, they can't meet minimum levels of deposits or something like that, and it just allows access to the banking system. Is there much of a difference between what you're describing and the traditional view of what a postal banking system is?
Yeah, it's funny because I was at the Fed for 39 years, and about 25 years ago, I was dealing with a very similar proposal where the post office wanted to be able to open up accounts. And I guess they've been trying that. They do money orders, so postal money orders are something they do, but they never really get the authority to actually open an account. Similarly, there's legislation to try to have banks open no-frills account at low costs. And then there are some volunteer efforts at that. So it wouldn't act any different than a bank account, although it really depends on, is it post office money that's actually there? Is the post office the one that's liable for the money if it's lost or stolen? So once again, it may act similar, just like a bank account or a digital currency, but under the covers, the legal status of it, how it works, what happens if you're defrauded, can you get your money back? All those things would be very different. And that's sort of what makes this a very complicated question, because there's a lot of nuances on how these things differ once you look under the covers.
When you described what happens right now when I go into that restaurant example where there are credit card fees and there are some delays in transactions, those fees exist because setting up and maintaining these accounts is expensive. That's why banks, a part of why they have minimum deposit levels. So in a regime of a central bank digital currency, is the Fed taking a hit on profits? Is the taxpayer kind of supporting those operations and mechanics behind a CBDC?
Well, it's definitely costs, and it would either be the central bank or the Treasury, because the Treasury is the one that actually issues the money. The Federal Reserve is just a conduit to get that money out into the banking system. But there are costs there. So you don't pay for a dollar bill because it's a public good. There should be no friction in getting money. It's a public good, and it's there to help promote commerce and also allow the free flow of money. So if you think about it, if the digital dollar was created, there'd be a cost, but it also should be, in my opinion, it should be a public good and be free. And the cost of the electronic systems are going to be dramatically lower than the paper currency. So it's not just printing the money, it's also moving the money and getting out of circulation. It's also the costs for banks and merchants to move the money. So there are definitely costs, and there definitely would, in my mind, need to be free or near free in order to keep its status as a public good.
What is the problem this is looking to solve? Is it just trying to minimize all those frictions you talked about to limit the costs and the fees that go along with the transaction system right now? Or why are central banks really considering this right now?
Yeah, so first of all, jurisdictions vary, so the use cases will vary. There are a number of Caribbean island nations that have a digital currency, mainly because there are a lot of unbanked people on those islands, and it's real expensive to move paper currency, amongst those islands. So for them, there's an efficiency play where the digital currency is just cheaper to move. If you look at China, who has, I think they're still officially in pilot, but billions of dollars worth of transactions, they obviously want to control the flow of money. They likely want to see where that money is being spent, so they have a particular reason for it. Maybe they think a digital yuan will help them move the dollar out of its reserve status. But in many cases, those use cases, potential use cases, are still being studied. In my opinion, I think there's a play, even in the US, for as good as our banking system is, for the unbanked. 20% of the population have bank accounts and still use check cashing services. And those are fees that are being borne by people that really can't afford it. So if the unbanked or underbanked had access to digital dollars that were free to move, you'd be giving money back to the lowest end of the economic spectrum. There are some that think that international payments, which are expensive and slow and cumbersome, could be done better with a digital currency. That's a really complicated area, but a potential there is for cross-border. And then just for reducing the costs to businesses, some think that interchange fees are very high. I'll leave those opinions to the listeners. But if there are digital dollars that were being moved, then many merchants would want those over the credit card fees. So there were many different use cases during the pandemic. A number of bills were introduced to create a digital dollar for COVID relief payments to more quickly move money into the hands of citizens when that's needed. I think that's obviously also a very political area. So I think there's use cases, but every use case comes with a cost to someone in the ecosystem.
Yeah, one specifically that I think of. So the friction that comes with delayed timing. You try to send an international wire transfer or even money within the United States, and it can sometimes take 2 days. A credit card charge is pending until it clears all these hurdles. That time can be frustrating, but is that the sign of old-fashioned technology, or is it actually a feature rather than a bug? Because it stops fraudulent transactions from going through unaccounted for, right? If there's a couple days where people working within the system have time to flag suspicious activity, if you have these transactions going through immediately, does it add some vulnerability to fraudulent activity?
Yeah, that's one of the biggest questions surrounding this. And I'll add in, besides just fraud, I'll add in privacy, because all these things you put in to help prevent fraud, create the potential for less privacy because you have to understand a lot more about the transaction. So true, going slower allows you to do checks, but it also has a cost. The cost of that money being tied up costs the economy because it's not productive. It's not being used. But systems more and more are getting faster and faster anyways. A few years ago, the Federal Reserve created a brand new faster payment system, so you can almost instantaneously move money in what used to take hours or days. So the system is getting faster, but that does create challenges for fraud prevention and for other, anti-money laundering, et cetera. Unfortunately, the bad guys are having better technologies from the fraudulent side, but then the banking system and others that are trying to stop the fraud and the money laundering, they're getting better as well. So it's really trying to speed it up, but still be able to do all those checks and balances.
In a regime where a central bank digital currency and an account at the Fed is available to me, of course, that would come at the expense of me taking some money out of my commercial bank account. So, wouldn't a CBDC take business away from existing commercial banks? And could that radically change the way that financial intermediation happens in the economy right now?
It definitely would be some level of competition. Banks are also dealing with competition from cryptocurrencies and another type, stable coins, non-banks, and getting bank-like services like a Walmart, that's competition. So I think there would be some drain. But if you think about it, if I've got money in an interest-bearing account at a bank and I have the ability to get digital currency, that digital currency likely would not have an interest rate. So I'm not going to take all my money out of the bank and throw it into a digital currency. I'm going to use that as a transaction account, much like I'd use my checking account, with that has little or no interest. So I think there'd be some money moving out of banks into a digital currency, but I still think it'd be a relatively small percentage. One big risk that does come along, though, is when there's some sort of a bank run or a crisis where people are not trusting banks, or other things happening, people may take their money out and put it in digital currency just for safety purposes. So I think it could, in some ways, possibly exacerbate a run on a bank. But in normal times, I don't think people would be storing a lot of value in a central bank digital currency, because then they're just losing interest. If I was a bank, and I've talked to a lot of banks about this, if I was a bank, I would want to make it as seamless as possible for my customers to move money in and out of central bank digital currency, to make it easy for them so they won't be tempted to take large amounts out because it's cumbersome. So I think if they make it seamless, people would generally leave their money in the bank and just move it into digital currency when that's a preferred way of making a payment, in my opinion.
I see. So a CBDC account would be like a positive balance on my PayPal or Venmo or Apple Pay, where it's available for transactions, but it's not really going to be the primary account that I deposit my money.
Yeah, and if you think about it, most likely, and there's, once again, various ways of doing this. The way we were looking at it with Project Hamilton is there'd be an account that the Federal Reserve would manage that would have a balance in it for you or for me. And if banks were smart, they could link to that balance and just show it on your bank statement. So that, here's your checking account, your savings account, maybe your brokerage account, and they would know how much you have in digital currency too. So it would basically look seamless to you. And I think that's a positive on a bank's side, is to accept it and embrace it if it does come about.
Because the plumbing of the financial system would change a bit, how do you think the effectiveness of monetary policy might change? Because, of course, when the Fed changes the overnight lending rate, the federal funds rate, it channels into the financial system and into the real economy after a number of kind of downstream effects. And if there's a lot more money in these accounts at the Fed, could it make monetary policy less effective or more effective? How do you see that happening?
Well, first of all, I'm not an economist, but I've talked to many of them, and I've been involved in discussions around the world on this. One way people have thought about it is, I don't believe this is the right way of doing it. Some countries have talked about putting an interest rate on the digital currency. That way, if you want people to spend their money, you could put a negative interest rate on it, which would basically get them to spend it or put it back in banks. Or if you want money to go into digital currency and to increase the balance sheet of the Fed, you could increase the interest. It could be another monetary policy tool, but quite honestly, I don't think that's the right way of doing it. I don't think we would ever do that in the States. I just think that that is fraught with other issues. So besides that, I think the amount of money in a digital currency, well, we could account for it so the economists would know where it is. It would be the same as cash relative to how economists think about money. So I don't think it would have a dramatic effect on monetary policy, because the volume wouldn't be that high that it would make a difference. And the rate of moving money into the system and out of the system would not be much different than how regular digital dollars work today, which most people are getting paid in digital dollars, not getting paid in paper currency. So it'd be a little faster, but not faster enough, I think, to have a major economic impact.
So much of our financial regulatory framework focuses on how commercial banks operate together and with their customers. But of course, there are things on the periphery, the shadow banking system, all these ways that money moves around in banking esque institutions. Do you think there would have to be a new regulatory framework to govern a central bank digital currency? Or is it not really going to introduce any new risk that we think about when we think about commercial banks?
Well, I think whenever you change the plumbing, you introduce opportunities and risks for sure. And there are some winners and losers. It's just whether they are massive effects on those players. When Chair Powell was asked about digital currency a number of years ago, he said he would seek legislation to empower it just so there's no legal question about its status. Because if it was going to be issued, there'd be lawsuits from those who don't want it that would block, the Fed from issuing. And there were many laws that were not introduced but never passed that would either authorize it or prevent it. So there's a lot of legal and regulatory questions. You'd also have to think about what happens from a policy perspective. If you lose your digital currency, your central bank digital currency, can you get it back? If you lose your crypto, you don't get it back. If you lose your digital dollars, would you get it back? So there's a lot of policy questions. And I think who can touch the digital currency would be a regulatory question. So, for instance, Walmart could get digital currency by the fact that I walk in and give them digital dollars, give them CBDC to buy something. They now have in their account digital dollars. Well, what can they do with it? Could they try to pretend they're a bank-like organization because they've had digital dollars of their own on their balance sheet? Those are important questions would need to be fleshed out. And I'm sure there's be unintended consequences and things we haven't thought about yet, because I think one of the values of going with a digital currency is it's going to create new innovative ways of moving money, like micropayments. If you can make a digital dollar that's fast and free, why wouldn't you be able to move a quarter or a nickel around the system in a way that is now efficient? And I think the startups and the established institutions will really innovate around a central bank digital currency in ways that we haven't thought about yet.
Tell us more about your work leading Project Hamilton. Were you thinking, you and the team, just thinking about topics really in the abstract, like we have been, mostly so far, or is it about the operational obstacles that might come up? What were you guys really researching?
We were a technical research team, and one of the motivations was because China was about to issue their digital currency. You had Facebook with their project Libra that was going to be a digital currency. JP Morgan with JPM coin. So a lot of people were really concerned about whether the dollar was going to be left behind with all this other activity. And in March of 2020, there's a bill that would have forced the Fed to create digital currency in 1 year, which is impossible. So our whole reason for being was to understand what's possible. Technically, what could we do to help build a digital currency? Because if we're asked to do it, we're years away. So now, saying that, I hired a number of people, mostly out of crypto, because we wanted to think differently about the technology. We want to look at cryptocurrency and how those work to see, could we build something new and different, not just follow the old way of doing payments and money storage. So it was technical research. I think we were one of the most advanced projects in the world. We were actually able to get our technology to process 1.3 million transactions per second. So in 1 second, we could do 1.3 million transactions. And from a technical perspective, that's really valuable because you need the money to move fast. We weren't policy people, but there's a saying that we used to use on the project: policy informs technology, but also technology can inform policy. Like if we could make a digital dollar that was totally private, but you could still do AML checking and fraud prevention, that would allow you to make some different policy choices. So we were trying to both see how far we can go with our project and also understand different ways of allowing policy decisions to be made more openly and without being tied to, for instance, the fact that it's a paper dollar. There are policy questions that are answered because it's paper. And that shouldn't be the case. We should be able to allow policymakers to make any decisions they want, and we would be able to implement. So that's really what we were after.
You've graciously responded to the questions that I've posed, but as you look back at the project, now that it's wrapped up, what were your main takeaways from it? Do you think that a digital currency is inevitable? It's a good idea? It involves too many risks? How do you sum it up as your main elevator pitch for why it would be a good or bad idea?
Yeah, I just think it's inevitable, and I've said this, but also followed up with inevitable could be really far away. So I just think the way we have the ability to do new and amazing things with technology, it'd be a shame if we didn't speed up and improve money itself. So I just think it's a lost opportunity to not take advantage. Or to quote, I think it was Jodie Foster in Contact, if there's nothing out there, what a shame. What a waste. I think there's use cases. I think we'd be very thoughtful and very careful because it's the dollar. We don't want to break it. But I do think we can do it in a way that can have some benefits for fraud, for international, for the unbanked, but without upending the system that exists today. That's my view. And I just think it's too much of an opportunity to miss and to do really thoughtful technology planning and policy debate. And I think we'll end up eventually with one, but it would definitely take 5 years at a minimum to get it off the ground.
To wrap up the conversation, what is the current status of legislative efforts for CBDC in the United States? Is it kind of on hold now that other regulatory projects are being prioritized? Is there a big lobbying front to do it, to not do it? Where do we stand right now in August of 2025?
Well, with the new administration, one of Trump's many executive orders basically said there will not be a central bank digital currency in the United States. Now, that executive order can be questioned, but right now that's where we stand. This administration is very pro-crypto and pro-stablecoins, so there's a lot of legislation that enabling more uses of crypto and stablecoins, so that's moving forward. But right now, basically, the point is moot because of that executive order. If we're at a different time and before this administration, the question was always, do we need a legislative change to actually make it possible? As I said before, Chair Powell had said he believes the right thing to do would be to get a legislative approval just to make it clear who has the authority or who does not have the authority in this case. So right now, we're basically dead in the water. There's still technology research going on in debate, but it is definitely a lot of lobbying going on still on that question. It does have a lot of impact, obviously, and so that means lobbying.
Jim Cunha, thanks for coming on the podcast.
Well, it was a pleasure. Nice talking with you.
That was Jim Cunha, former executive vice president at the Federal Reserve Bank of Boston. I think Jim sums up the prospect of a CBDC in the US well when he says that adoption is inevitable. It's just unclear what the timeline will be. The technology he describes would improve many aspects of the current payment system, but such changes would need to happen gradually so that the plumbing of the financial system does not come under unnecessary pressure in the transition process. The August CPI and PPI next week will give the latest clues about underlying inflation and the extent to which tariffs are being passed through to consumer prices. Both are expected to rise 0.3% and not sway the Fed from cutting rates at its next meeting. Although the July CPI showed few signs of tariff pass-through, prices for core services did accelerate. These prices are less sensitive to tariffs and are much harder to slow down once they pick up momentum. So we'll have a close eye on those components to gauge where Fed policy could go after this month's meeting. The Fed starts its pre-meeting communications blackout at the end of today. A 25 basis point rate cut is our base case for the September 17th decision, but it won't be a total shock if there are dissents favoring a 50 basis point rate cut or no cut at all. The FOMC will also release a new Summary of Economic Projections, or SEP. The last SEP, in June, showed two distinct camps within the FOMC. Those who think the upside inflation risks from tariffs warrant caution moving rates any lower, and those who think imminent rate cuts are needed to stop cracks in the labor market from getting any worse. August retail spending will be released on the first day of the Fed's two-day meeting. Personal spending has been volatile this year as consumers try to front-run different policy changes, so it's been difficult to establish an underlying trend for the consumer. Car sales fell a bit last month, leading to initial expectations for stagnant retail sales data. Also next week, the BLS will release its preliminary benchmark revisions to the establishment survey for the time between March 2024 and March 2025. Most analysts expect payrolls to be revised lower over this period, but remember that they will not impact current estimates for jobs growth between April and August of this year, so they will only provide a limited snapshot of current labor market momentum. That's all for today's episode. Thanks again for listening. I'm Will Compernell, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.